Well, good morning, everybody. Good afternoon, good evening, wherever you sit, wherever you listen to. Look, it's not the familiar voice you start off with the intro, but it's my fault we haven't got a guest today, so I thought we'd be easily aligned for me just to jump in there first before these two absolutely take the airways. Once again, we are joined with Abraham and Matt's back on your SoapBox edition. Hello, guys. Welcome. How are we?
Good, thank you, Jake. Yeah, afternoon, where I am anyway.
Now, don't worry, guys. I'm not here to jump on any of the financial news because I think that would be a literal waste of everybody's time. I'm just here to thank you guys for listening. Don't forget to follow. Don't forget to comment. And that's essentially it. Now, I'm going to hand off to Matt and Abraham.
Jake,
to tell
before
you
you
what-
go,
of
shouldn't
course.
we be begging the audience to review the cast, rate the podcast and all that
Yep.
nonsense? No?
That's very true. Yeah, sure. Begging is a lovely term we should be using across the board. Yeah, that's absolutely. I don't want it. Yeah, I am now begging you to review, comment, subscribe, wherever you can. Share the hell out of all of this because that's what we need to do. As we've detested, look, I still need a job. I still got to be here at some point. You're going to need to start reviewing at some point and commenting. So please definitely do that. We can bribe them. Yeah, by far. Yeah, contact Abraham on
Well,
LinkedIn.
Yeah.
Send him a message.
What I was thinking is if you left us a review on Apple Podcast or one of the major podcast outlets out there and screenshot it and ping it to me on LinkedIn, Abraham Okusanya, there aren't two of us. I will send you a copy of this baby. This time is different. Shockproofing Our Client by the legendary Nick Murray. Matt, have you read this?
No, and you've refused to give me a copy, so now apparently I've got to go and write a review for our own podcast. I was thinking the prize was going to be, now you've got yourself a magic lamp, as Jake and I can see, that you can summon up anything, and therefore the prize was going to be something better than a book, whatever the wants.
Well.
There we go. It's an incentive to watch us. Like I said, don't forget we are available to watch. So you can't just listen, you can just watch YouTube, Spotify, Apple, anywhere you are. You can watch all three of us, mainly them two, get into the topics with a guest. Okay, I think we've done enough admin stuff for now. I think we get into it.
So, Abraham, you raised a couple of meaty topics for today's show. I noticed very investment focused, which is very you, but some brilliant papers actually out recently. And what a time for the papers to be launched. What a time to talk about it, because my goodness, it's we seem to be back in Q1 Trump madness syndrome with markets. Do you want to give us a sense of what you've been up to that's led you to start reading academic papers?
Yeah, so this is the investment geek corner of the soapbox. So there are a couple of papers out this time of year. The famous Global Investment Return Yearbook 2026, Timeless Lessons for Today's Investment Challenges by the legendary professors Dimson, Paul Marsh, and Mike Staunton is out. You can actually get a free copy of the summary. There are this thing is a treasure trove of fascinating insight about long-term market return, asset class return over the last 125 years now. So yeah, fascinating paper. Just a couple of things to draw out from this paper that might be relevant for today. So of late, we've had a lot of noise about the Magnificent Seven and their dominance on the US and global equity market. And the question the comment that you often hear, or question that often comes up is like, well, what happens, the Mag 7 are, let's say, 30+% of the S&P 500. What happens when these companies actually lose their market share, their mojo, or they sunset somehow? Well, history has the answer for you, because would you believe it or not, Matt, can you guess? Let's go back to 1900. What proportion of the US market would you say is in, industries that no longer exist? Let me pick one. Railroads, for instance.
How much of it used to be make up the markets in the US? It was large. Oh, I should have made more notes on the papers you made me read in the last 48 hours. Half of markets were railroads. Yeah.
Yeah, higher. 63% of the US market was essentially in railroads. Today, it's less than 1%. Yet, this blows your mind and mine. Railroads actually outperform the wider US market. The point being, we often associate new technologies with bubble and period of, we say, oh, technology, new technology would disrupt, old ones, and the old ones will obviously underperform. But the reality is that the equity market just doesn't work that way, because yes, new technology come along and displace the old ones, but actually the engine that is the capital market continues to grind on. Chances are you are already holding the next big thing in your portfolio. They might be small now, but ultimately they will, when they do accelerate, this is the beauty of the indexing. It's already in your portfolio. And one other little, one other piece of stats is like 70% of the US market today, of industries in the US market today, didn't exist in 1900. So you have this dynamism that is just beautiful, just the way the capital market works. So it's a long-winded way of saying don't fear concentration or the magnificent seven, the haystack, rather than looking for the needle in the haystack.
Yeah, 100%. And actually, the two reports that you flagged for this one, I mean, maybe we can get Jake to stick links in the show notes for these. I'd encourage everyone who's listening or watching, and bless you if you're watching, to actually give these a read. I mean, they're not heavy reads. There's some great charts, great visuals, great stats. You're absolutely right. I mean, roll back 6 months, probably everyone was all of a sudden an expert on the Mag 7 and why the Mag 7, wasn't going to continue to produce the outsized market returns that it has in the past. I had clients who suddenly telling me things about chip supply, and it's just so down in the weeds. We kind of justify our beliefs, don't we, after the fact. That's what we do. Our process of thinking is less rational, more rationalizing, in fact. So there's a lot of that going on. And then all of a sudden we're into Q1. There's potentially an oil crisis. Suddenly everyone's an expert on oil futures. I mean, it is nonsense, isn't it? It's noise. We put out something, I think this week, actually, just saying, actually, there's a political commentator who I love called Ian Dunn. He's brilliant. Everyone should go and check him out. Just very sweary, very honest about politics. And he wrote this Substack where he said, given the turmoil with global politics, I don't understand why global markets aren't responding to that. Why in my space, where I'm really stressed because I've got political news hitting me every 10 minutes, why are the markets not more volatile? And I just thought that misunderstands it. To your point, the markets don't care about your politics. I mean, yes, markets are marginally down year to date. I mean, tiny amounts at the moment. There was a really good chart in that chart book showing that actually political risks are never what preempts market downturns. It's always economic stresses and shocks, which very often don't align with those geopolitical risks. So yeah, you're absolutely right. Back to the concentration risk, bubble risk. We've had clients asking us to pull them out of US markets or reduce their US market exposure, and we've been saying that's making a huge bet against some of the best companies in the world. Not necessarily always the best run, but in terms of what they're doing, the most profitable. I mean, these companies are beasts of profit making entities. Betting against them that's a big call to make when you're talking about your own money, your family's financial security. But I like your bubble point, because there's often a narrative, isn't there, about what the next bubble is. What are we in a bubble? You know, whatever it is, and everyone looks back to tulip mania in Holland back in the day. But actually, it doesn't matter. I came into the profession when there was a bubble bursting, which was that tech bubble. We had 3 years of successive double-digit losses, year after year after year. It was miserable. But actually, markets have just rocketed back and onwards from there onwards and produced huge gains, increased the wealth of anyone who's has capital and who is invested. And if there is a bubble when it pops, like you say, it doesn't matter because you own all the other companies that are going to become the next mini bubble or however we want to call it. So yeah, you're spot on. I mean, there's so much in there actually that we could easily devote an entire episode to.
Yeah, absolutely. And I want to geek out these papers, Matt. And right now I don't know which direction to go because you've kind of leaned in the economic crisis versus geopolitical direction. You know, there is that. In the DMS paper, there is another piece of work about gold, for instance, and whether gold is a good edge for inflation. Basically, the point the DMS guys made was that the relationship between gold and inflation is actually weak. Of the 28 years, 28 years in the database where you had high inflation, they define this as being more than 3%. Gold returns were negative in 13 of them. 13. So you kind of think, well, if you are if you're thinking about holding gold as a edge for inflation in the short term, it doesn't, it's a coin toss. Sorry, it's a coin toss.
Yeah.
It's a coin toss, basically, as to whether it works. Now, in the long run, especially the post-Bretton Woods, sort of post-1945, holding gold in the longer term actually outperform inflation, but you might as well just hold equities, So, again, this is why I like going back to the DMS research every year, because it reminds you of, some of these fundamental investment lessons. And it is very, very relevant to a lot of questions that we're being asked by clients these days.
Yeah, you're absolutely right. I mean, it's the antidote to the noise, the marketing noise that's put out by people who've got an axe to grind, frankly, people who are charging outsized amounts to pretend to beat. Well, no one really pretends to beat the market anymore, do they? That marketing narrative has changed. Now it's all about diversification and risk control and control on the downside. None of which has got any more evidence behind it than outperforming the market. But there is, I think the problem is these days is that we and clients are constantly in receipt of news flow. And it's so detrimental actually to the long-term investor. And so papers like this are great. They're not as dry as they initially appear, but because of the time horizon, the lessons you can learn from it are the right ones. That's the really important stuff. Now, actually, I wanted to pick up on something that was in there, which I found fascinating. It's the first time I've seen it, not in the UBS paper, but actually in the main paper from Dimson et al., who's a bit of a quiet legend actually in investment management, and that was the long-term returns. And this kind of brings out the active versus passive debate, which I'll get your views on because I'm interested. Which way you're going to go? So over 100 years, equities have produced these outsized, huge growth in capital. average is in excess of 10% per annum over that period from equities. And yet, the bit that stood out for me is actually you had to own all of the equities to get that 10%. If you owned, so the mean average return was a lot less. It was more like 6%, I think. But then actually, if you owned the median stock, thousands of stocks, about 30,000 stocks in this data set, 30,000 company shares, you actually had a negative annual return over those 100 years. You lost 7% a year if you owned the average share. Now, the point is, when you look at the data, there's no one can say that they know what's going to be the average share, what's going to be the above average share. As you said earlier, you own them if you own all of them, and you just know that you will have the future winners in there. So it really gives the lie to this active management argument, I think. You can jump in and correct me if you think I'm wrong, where the argument is you can invest in a much narrower range of stocks and a manager is going to make sure you own the right range of stocks. It really, the argument doesn't work, because you need to own such a small proportion of those total 30,000 stocks to get all of your return. Like 90% of the return is coming from a small number of stocks. If you get that wrong, you're going to either wipe yourself out or inflation will wipe you out.
Yeah, so you're absolutely right, Matt. So what you're referring to is the Bessenbinder's paper. So this professor at the Arizona State University is updated his prior research, where he looked at the concentration of and return as U.S. equities over the last 93 years. The paper was originally published, I believe, in 2017. He's now expanded it to the end of 2025, and essentially now he has the same 100 years as as the 100 years, which is consistent with what Dimson's et al. Do. And essentially, absolutely fascinating, Matt. Yes, to your point, the median stock, the median equity in its lifetime actually loses money. Right, compared to, this is versus treasury bills, for instance, so whereas buying the haystack is, would have given you, as you said, an annual return of 10 plus percent. And that's because you have this extreme positive skewness of return, which means that a small number of companies are driving the return. 59% of companies will lose you money. 59% of stock will lose you money, or in their lifetime. Yet, over that period, the US stock market has created 91 trillion pounds of wealth. 91 trillion pounds. Now, the thing that blows my mind is this, Matt. Between 1926 and 2016, 42 trillion pounds of wealth was created. So we're talking 100 years, and 91 of it, 91 of it, January of 1926 to December of 2000, 91 of it created $42 trillion of wealth. The last 9-year period, from 2017 till the end of 2025, created $48 trillion of wealth. It doesn't stop there, Matt, because when you look at this, I just understand, I am constantly surprised by how counterintuitive this is, and I have deeper appreciation for what we do, and this conversation that you've been having with clients, because of that $43 trillion dollars of wealth created in the first 91 period, you needed 89 companies to create half of that wealth. 89. Well, the last 9 years, where you'd created, the markets created $48 trillion of wealth, you needed 13 companies, 13 to create half of that wealth. So I wouldn't want to be an active manager. The period of this extreme wealth creation in the capital market also, is correlated with a period of extreme, if you use that word, concentration or high concentration. And, if you look back now and you say, which companies are driving wealth creation? Well, your guess is as good as mine. Apple's created $5 trillion of wealth in its lifetime. And Nvidia's created about 40 something trillion, $4.5 trillion of wealth in its lifetime. Microsoft has done what? 4 trillion, another one. Alphabet has done 3.5 trillion. Amazon's done 2.2. Let me find you one that you probably haven't heard of. No, you have heard of all of them. Walmart has done just over 1 trillion, 1.2 trillion of wealth created for their shareholders. The point, though, is that wealth is being created by a small number of companies out of 30,000 companies, publicly listed companies in the history of the U.S. market. You have 9 creating a substantive proportion of the wealth. Would you want to be an active manager if you just miss any one of those magnificent wealth creators? You are in for trouble.
Yeah, and I think this this feels like to a lot of people, probably a very academic debate, but actually we've seen some clients recently who've come to us who've come from fairly traditional active managers, and in one particular case which really stands out, this active management firm, well-known firm, city firm, had managed to produce a 0% return over the last 5 years. It's staggering to think that that's possible given the returns just by being in the market for that period. I mean, it's insane. And the only way you can do that is exactly to your point. If you are missing any or all of those 13 company shares, which you can be if you're actively invested because you're in a narrower set of company investments, then you could have basically missed out. And it's not them. That's the tragedy of this. It's their clients. These firms have got massive client bases who have all missed out on huge amounts of compound growth. In the case of one of these clients, we worked out this couple were missing about £500,000 of growth by being with this firm. Now that's the practical reality of what we're talking about there. This is not a multi-million pound portfolio, not by any stretch. It's just into 7 figures, and it's 0 rather than about 50%. So it's £1 million portfolio. Now, £500,000, 50% return is the difference between retiring probably 10 years earlier or later. So bringing it to actual real practical, real life impact, these people are saying, well, I will charge you more and I will put you in a situation where you have to work an extra 10 years. Now, if they put that on the marketing boards at Waterloo, they go bust very quickly, but that's the reality. And I don't hear a lot about this. This is the thing. There's still huge amounts of UK private money invested with these traditional companies. And I think where this report is good is it just gives you the data and you think, well, there's the data. There's no arguing with it. It's just very obvious where this is going wrong.
We'll ask Jake to include links to the papers in the show notes.
That'd be great. They're good reads. They're good reads. They're not
good
too long.
And if you don't want to read the actual paper, or sadly the Bessembinder paper, I have asked Claude, my favorite assistant, to create a visualization of this, just a one-pager that you can, very simple to go through. I think most people will be able to understand the key findings of the paper.
And actually, to be fair, that Claude summary was brilliant. And I think
I am brilliant. No, you don't know that.
No. I was very clear and specific about who I was praising there, Abraham. So I think if I was a new advisor, new entrant, or I was a firm that was pivoting from active to passive, I would probably just take that as a PDF into every meeting. I mean, plus the timeline wall chart, obviously, but just a great summary of the power of just investing in everything, buying the haystack. I thought it was absolutely. I want to, if I may, because we've been vociferously agreeing so far, which makes for a very boring podcast probably. But I want to challenge you slightly on one thing that was in the data. I might have misread the data, so I'm very happy to not be the expert on this call today. There seemed to be a suggestion, at least in one of the papers, that the idea of factor investing maybe was weakening a little bit. The concept of not buying the market in its allocated weightings, but actually tilting towards these longer term good areas like smaller companies or emerging markets, or I think those are the two of the main ones that you guys use as investment managers. Convince me why factor investing is still a good idea.
Yeah, no, it's a very, very good point. Yeah, so again, this is the DMS paper, or the Global Investment Return Yearbook, that basically says, well, look, in the long run, if you hold it for long enough, factor investing, particularly value and small, have delivered good returns, or slightly better returns than the market, but that they can actually go through prolonged periods of underperformance, so the phrase in the paper is like, factor investing can sometimes deliver disappointing results. We know that 22 of the country decades saw negative premiums even over entire decades, and this is consistent to with the work that we've done on this, which is like, if you run rolling 10-year periods for small and value, what you tend to find is, broadly speaking, about 2 out of every 10-year scenarios, 10 years, this the factor premium is going to be negative. And so again, we call it risk premium for a reason, because it's not guaranteed. There are nuances to this, and you have to be willing to wait for a long time. I would say over a decade if you're going to be factor investing. And this is what I say to people. I don't say it as much, but I say to people, if you just want to hold the market, that's a pretty strong investment approach. If you've got very long time horizon, you got 20, 30 years, that sort of thing, and you are willing to accept risk of slight underperformance relative to broad market indices, you can. That's what factor is there for. In 8 out of 10 periods, you will be right. In 2 out of 10, you will slightly underperform. It's called risk premium for a reason.
Okay, you convinced me it's worth having it as an option for the super long. I mean,
you're not a factor fan, then, I take it.
Massively, no. I mean, it is slightly more expensive as well, and to invest like that, and we need to be cost conscious when we're dealing with other people's money, definitely. But yeah, I mean, we do have some clients where it's appropriate if they understand the super long term nature of making that bet and have got that kind of investment time horizon. I mean, if you're talking about multi-generational wealth and it's going to be there for decades, and the cost differential is not too much, then yeah, I get it. Great. Well, so look, did you have anything more on these two papers that you wanted to geek out on, or am I allowed to drag you onto the subject of the great wealth destroyers?
Yeah, you've indulged me enough, Matt. Let's go. Let's talk about who's
brilliant. Well,
so
look, I mean, this is probably far too big a subject to do in one go. But the paper got me thinking about, well, actually, what destroys wealth? Because we can see the global markets. If you buy the entire market, that grows wealth at these extraordinary compound rates. So what is the inverse? What's the reverse of that? What destroys wealth? And I think, although we have some clients where active management is right, I mean, few and far between, very specific sets of circumstances, I would say that for an average active manager, for the average client where that doesn't suit, that's potentially a wealth destroyer. I mean, we talk about losing £500,000 or not gaining £500,000 and having to work much, much longer. That's definitely an example of a wealth destroyer, right? I think we see another big one in the work that we do with a couple of large employers where we work with their staff on a salary sacrifice basis. They can pay tax exempt and get a timeline cash flow from us, which is great and a great service, a way of meeting lots and lots of people in very different financial circumstances. But all of them have pension schemes with lifestyling, which we hate as a firm. I'm just putting it out there because I think actually lifestyling from the corporate pension industry, and I will call them an industry, has probably in aggregate over the decades destroyed more wealth than maybe any other of the big. I could list 5 big wealth destroyers. We've covered one already. I think this is the second one. This idea, which dates back decades and really was wiped out by legislation over a decade ago, so I've got no idea why it still happens, that as you get towards your set retirement age of 60 or 65, whatever that is, your company pension scheme starts selling down your shares and buying you something else that's less volatile, so some cash, some government gilts, etc., etc. You used to do that because you used to buy an annuity. So what you were doing is you were trying to stabilize your pension fund to the point where you bought the annuity, you buy the annuity, and that's a fixed income for life. Now, I was struggling to find some reliable industry stats, but I did find one that suggested that something in excess of 80% of people are now taking pension drawdown rather than buying an annuity. Annuity purchase rates are very, very low. I mean, I haven't personally organised an annuity since 2004, I don't think. So it's a long time since I've fixed anyone's pension into a lifetime income. And yet this still goes on. So if you're going to have a 30, 40, possibly in the future, year retirement, and you're going to draw from your pension, that pension fund may be invested for longer than you've been working and building it up. Why on earth would you want it to be in lower volatile assets? I mean, it seems insane to me. So I don't know. I'm seeing a lot of nodding, so I'm assuming that you agree. But I mean, to me, it seems to be, it's almost, there's also more controversy around it, I feel. Personally, to me, that's one of the great ways in which the UK population have been really hurt to their own detriment of their lifestyles.
I couldn't disagree with a word of that, actually. As you were talking about this, what I was thinking is, yes, why isn't there more controversy around this? I'll tell you why. It's because it aligns with broad regulatory overreach that we see today, which is, we have, panicked people out of investing. We've covered everything with risk disclosures. But hey, as long as it makes the regulator happy, then that's fine. So that's the only reason I can think of. Obviously, lifestyling thing has its origins in the retirement annuity industry, which is the insurance industry, and that's no longer the default. So it begs the question: why do you still have this thing around, and why aren't pension schemes, workplace schemes, personal pension schemes, why aren't they taking this more seriously to mimic what is more likely for their for the average member? And why isn't the regulator picking them up?
Yeah, I think a really good point actually about risk and regulation. I think it's almost that corporate compliance culture where I think personally the default in these company pension schemes should be equities, and then the members should be encouraged to change that to lifestyling if they're the 1 in 10 or 2 in 10 that are planning on buying an annuity, and it should be that way around. But I guess if you spoke to a lot of these pension trustees, they'd probably say, well, we're more likely to get sued by the person who gets defaulted into equities and then tries to retire in a year when there's a market downturn than we are by people slowly losing money not realizing quite what damage we've done to them. I mean, maybe that's a bit too cynical, but I do think it should be more of a scandal.
No, it's not cynical. I mean, I think that, obviously, psychology tells us that people feel lost, twice as they feel as they feel gain. The emotional effect of loss is twice that of the gain. But also, I'm thinking that if you were in one of these lifestyling product or low equity product, you don't see what you're losing, so it's opportunity foregone, rather than if you're in equities and your portfolio goes up and then it comes down, say, by 5 or 10%. You're always judging where it is now relative to where it's been. Whereas if you're in a 40-60 portfolio where it hasn't quite gone up, you just look at your pension and you think, it's not performing, but that's okay. I'm not losing anything. So yeah, I mean, this all goes back to just the dire need in this country for financial education, for empowerment, for people to really truly understand what investing is all about, what risk is all about, and the incredible wealth creation engine that is the investment market.
Yeah, no, absolutely. And actually, that's a really good, so the mention of the 60-40 portfolio is a really good segue onto what you might find a slightly more controversial wealth destroyer if I raise it with you. Just before I do, just a quick story for you. I was the last time I had an argument with a corporate pension trustee about this whole lifestyling issue. I was in London. I was walking between two tube stations, I think, and I took the call on my mobile, and because I was concentrating, I stopped on the pavement in the street and had this argument for 10-15 minutes. What I hadn't twigged is I'd stopped outside of the Argentinian embassy. Within about 5-10 minutes, this police minibus flew up outside me, and all these guys with semi-automatic weapons jumped out and moved me on from outside the embassy. I think they thought I was some kind of terrorist, which was somewhat nerve-wracking. I think I've still got PTSD talking about corporate pensions as a result. So you mentioned 60-40. I wanted to raise this with you. So for taking the starting point, the global equities are the place to invest if you're a long-term investor. I want to talk to you, Abraham, about risk profiling tools.
Mm-hmm.
Because you've got one, you've built one. It's a very good one. We use it. I just wonder, I mean, I'd be interested to hear, because you will know the stats, what the average person ends up with as the average asset allocation. Gentle challenge. I wonder if we're slowly destroying wealth ourselves, you and I, by letting people do these tests that end up with a result where they end up with less in equities. There you go. I'll state it controversially, and then I'll row myself back from it later on.
No, it's okay. I can take it. Is that it?
Yeah. Absolutely. Was that not enough? I can double down and come up with some other stuff.
Well, look, I think a couple of things in my mind. So I was speaking to my good friend Dennis Hall a couple of weeks ago about this. He doesn't do risk profiling, like he doesn't do the risk questionnaire thing. And he has a framework that he uses to explain risk to clients, and he uses, timeline to model the bad scenario, the worst case scenario, and the impact on the client's financial life. So he has a very good framework around it. And I am all for that. As a matter of fact, that is where, if I were king today, that's where I would be. The reality is that the average financial professional, financial advisor is not there. Is actually the opposite end of that, which is, to, maybe do risk profile, have a conversation with client, but broadly speaking, they would align with what the risk profile says. So here's my thinking, which is like, okay, how can I get people gradually over to this side? And so I say, if you must use a risk profile, use one that we've created that doesn't take the risk profile in isolation. So you would see, once the client's completed the risk profile and the result comes out, of course, you can have conversation with them. And more importantly, you can put the portfolio that risk profile dictates into their financial plan and actually see how it stacks up and maybe create a different version of the financial plan and use a different, higher equity portfolio. And again, compare and contrast the results in line with their objectives. And if the proof of the pudding is the average, the median portfolio in timeline is 70% equity, 70-30. If you look at, IMA, investment management, but it's actually investment association, it's called now, starts. The average UK investor actually has something like 52% equities. So I'm sitting here thinking, okay, relative to average investor, the average timeline investor is actually doing pretty well because they have a financial advisor, of course, and of course, they have 15-18% more in equity than they do. Do I want to get everyone up that, risk scale? Absolutely. Am I king yet?
Not much longer, I'm sure. Not much longer.
It's a good challenge. I like it.
But I mean, actually, that's a really good challenge back. I like the initial swerve where you said essentially was the advisor. So it's on you, Matt. That was nice. That was a nice moment. But actually, I mean, that's really interesting because you're managing what now at Timeline? How many billions are you responsible for?
I don't know. Well,
if you don't know.
30.
30. Okay. So that's interesting, isn't it? Because actually 13 billion with a 20% additional equity content on average compared with the market sector. If you looked at that over the last however many years you've been doing this, 10 years plus, that's an insane amount of money actually to look at it the other way around that you have created by, as you say, not a perfect solution, but we are where we are, a better solution than most. If that's what it's prompted, you should be getting flowers delivered on a daily basis by my clients and other firms' clients.
Well, we haven't created that well. The market's done. All we've done is try and encourage.
Yeah, but look,
people.
Look, if the client isn't in it, the client doesn't get it.
Yeah.
If the client isn't in the market, if the client isn't in equities, they don't get the return, right? So yeah, someone along the chain, and maybe you've helped, maybe you've provided a nudge that has helped the advisor to create some of that wealth, or at least gain that wealth. It's not
You're
been
being
created,
too kind. People are going to say I've paid you to say that.
Let's move on. You wouldn't even send me a free Nick Murray book. There is absolutely no bribery going on here. Much to my disgust. I haven't even got a Timeline T-shirt I can wear. No, so I think it's an interesting one. It's a good one, and to be fair to you, the Timeline cash flow, not the cash flow, the risk profile, I think is one of the few, if not probably the only, that gives a mathematical assessment of capacity for loss, which is something that we've been looking for years, actually, for decades prior to you launching it. So no, it is market leading without a doubt. Great. Well, so those were most of my big wealth destroyers. The other one I had down was people themselves. And actually that IA stat gives you an indication, just the individual investor just chasing, constantly looking at their money, constantly chasing what has just performed well and rotating into it too late. All the usual bad behavior that we try as advisors to talk people down from. So yeah, those were mine.
Yeah, no, good stuff. What about sitting in cash? Do you know I think that is the biggest problem. I mean, like sitting in cash for a protracted period of time. I'm not talking about, for emergency fund, but for money that isn't needed in the short term, which I define as less than 3 years. 3 years, should really be put to work. And I was looking at some stats recently. Would you believe there is where is the data? 7.5 trillion 7.5 trillion of wealth, investable wealth in the UK today. That includes obviously asset on platforms, discretionary investment managed, private banks, and defined benefits, actually. Guess where?
This is going to give me a stroke, isn't it? I'm not going to like this answer.
There is 2.2 trillion sitting in bank accounts.
Horrific.
2.2 trillion. I looked at it the other day. I think it was I can't remember the exact figure on my head now of how much money we put into cash ISAs every year. I don't have the actual figure, but it's in billions. Look, that I will put.
I mean, that is, no, you're absolutely right. Okay, fair enough. You've pulled out your cash trump card for all my big wealth destroyers. Yeah, no, that is awful, isn't it? I mean, that money is going backwards in real terms versus inflation. That money is absolutely shrinking. We do see it. So some of the work, again, that we do with these staff of a couple of these big firms, one of them's FTSE 70, and they reach a point where they're suddenly, maybe the kids are off their hands. They're starting to think about, well, I've got 10 years run in maybe to retirement. I need to start planning some of this stuff. Come to us. And by the time they've sort of added up all their various pots they've been saving into, they've often got a lot more than they realise. But yeah, largely it's in cash products. And you find these people who've got, in some cases, 6 figures in cash ISAs. And it's painful because actually, if we were to be honest with them, if we would say, well, look, actually, if you'd have done a better job with your personal finances over the last 10 years, this is what your ISA would be worth. The numbers, and again, we as finance professionals, end up relaying it into numbers. Actually, it isn't. It's years of working.
Yeah.
It is extra holidays when you retire. It is more money to give to the grandchildren. It's freeing up time to spend in relationship with others. All the important stuff is being impacted to huge detrimental effects by this. So yeah, we do. I mean, that's a tragedy. Has given me palpitations just thinking about those kind of numbers. That's horrible.
Fantastic stuff. No, it's been good chatting to you again and chewing the cud, as they say. Thank you very much for your time, Matt. Thank you for your wisdom.
Thank you, Abraham. See you soon.